Yes, there's work going on right now to create a system using the blockchain for pricing metals.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and for our SD Weekly Metals and Markets Wrap this week, we have our co-host Eric Dubin and also Keith Neumeyer from First Majestic Silver, the CEO of First Majestic Silver. Keith and Eric, thank you so much for joining us today.
Well, Elijah, thanks for the opportunity.
It's always great to talk to you, Keith.
All right, so I was first going to ask you, Keith, if you wanted to give our viewers maybe an update on the gold and silver markets and where you see them heading in 2018.
Well, the last couple of years have been pretty challenging, and quite frankly, it's been pretty hard to predict, what's going to happen in this space. None of us have crystal balls, and I think that my predictions on both gold and silver have been pretty well out of market, and I've been wrong up until now, or at least the last couple of years I've been wrong. And I'm still expecting we'll be right. I did predict silver would hit $50 an ounce when I put First Majestic together back in 2002. And it did, in fact, hit $50 after 10 years. I would have never expected silver to go from 50 all the way down to 13 and be sitting around 16 today. That's a bit of a shocker to me. And quite frankly, with all the money printing and all the stuff that's going on worldwide, it confounds me why gold and silver are trading where they are. And, the flood of capital that's going into the major markets, the Standard & Poor's or the Dow or even more recently, Bitcoin or other things like that have, probably taken capital away from the resource space, the gold and silver space. But look, I know I've seen this 100 times, well, not 100 times, but I've seen this a dozen times before. This is very typical or very similar to me than what happened in 2000, 2001, during the whole dot-com, bubble, and the money rushing out of that sector actually started to occur. Is it going to be 2018? Maybe I'll be wrong one more year.
I'd love to ask you a follow-up question on that. What goes on in the institutional sector and what investors do when it comes to monies that they wish to deploy for junior miners and on up in the mining sector. And we've seen this huge move with Bitcoin. We've seen changes in the way retail investors, certainly in North America, look at precious metals and their purchasing of precious metals. Have you seen something shift as well when it comes to the institutional community and monies that are being invested in the mining sector? And I'd love your insight on that and how you might even see that impacting longer term or intermediate term supplies from miners, because we have skirted around, cost of production and pressures in the mining sector that in the long run are going to serve as a backstop against falling prices.
Yeah, it's a very good question, Eric. One of the key things that are happening in this market, and I've touched on it, a couple of times, but, this is a good opportunity to get a little bit deeper into this whole phenomenon, which is occurring in the mining space, because what's happening is if you go back 10 or 20 years, there has been specialists that have been experts in this space, right? They would know all the CEOs, they would know all the deposits around the world, they would monitor drill results. They would monitor progress within the company. They'd monitor development assets, and they would have a portfolio of entities, mining companies, spread across metals, spread across countries, spread across whatever, in different stages of development. And they would have maybe 400, 500 companies in their portfolio, and they didn't really care what was going on in the marketplace as a whole, because their specialty was mining. and their investors expected them to be good at what they did, and they had returns that, of course, during bull markets were quite phenomenal, and during bear markets may have not been as phenomenal, but still they survived, and those institutions were really the institutions that mining companies like First Majestic or First Mining or other mining companies out there who would go to raise capital. If we needed to build a mill, if we wanted to do an exploration program, we would go to this handful of institutions and say, hey, look, we want to raise $10 million. And, 4 or 5 or 10 of these institutions would all put in $1 million each or whatever the number. And we would be happy, they'd be happy, and we'd go on our life and try to do business. And that's the way the business operated for years. It went on for my entire career. Today, it's completely different. What's happened in the last couple of years is that these specialist firms the money inflows have ended. And actually, the outflows are still continuing today. So you see these big funds, I'm not going to name names, but these big resource funds who are the primary financiers behind the mining sector over the last 30 years are now disappearing, being replaced by ETFs. And this is passive money. And these ETFs, like a GDXJ or GDX, and of course there's many others, they're computer-driven, algorithmic-driven. They don't care where the mine is. They don't care how many employees are employed there. They don't care what the metal prices are doing. They don't care about anything about the business at all. And it's hurting the miners because it's reducing the financeability of mining projects on a global scale, because we can't go to the GDX or go to the GDXJ and say, hey, we want to raise $10 million. Can you participate? They say, well, there's no one to talk to. There's no fund manager. It's a computer. Yeah. So it's a completely different market today. So, that's why you're seeing these evaluations. So what happens one day sometime in the future, and this is to my earlier point, is when sentiment changes, when Tesla or Apple or whatever company, Google, Amazon, stops going up, and the money starts to say, hey, where else can we look? And they go, hey, there's this mining sector that's been underperforming for the last 2, 3, 4, 5 years. Maybe we should start deploying capital there. And then all of a sudden the money starts to trickle in. The algorithms kick in, boom, and the sector's up 200-300% over the next 12 months for no reason other than sentiment.
We had a little mini cost of that with the GDXJ this year and last year, and see it even reach the 20% threshold for individual holdings and create quite a mess. Yeah.
So that's where we are in this marketplace, and that's why Bitcoin does what it does, and that's why the S&P does what it does. I heard from a fund manager in New York a couple of months, I guess it's about 6 months ago now, that 90% of the trading on the New York Stock Exchange is computer driven.
Yeah.
Right, and I would like to get your perspective, Keith, on the current gold-silver ratio, because, as we've talked before, historically, the gold-silver ratio is more like 15 to 1, and the 20th century is more, 40 or 50 to 1. But right now, it's almost 80 to 1. What is your perspective on where that's heading?
Well, look, you've heard me probably 100 times, and, this is where I get criticized because, I'm this triple-digit, silver guy who's been saying this for quite some time. I was right with my $50 prediction, but I was obviously wrong, with my prediction of it going higher beyond that, and I would have never predicted it did what it did after it hit $50. So nevertheless, we're mining as a global industry 9 to 1. So for every 1 ounce of gold, mining industry as a total mines 1 ounce of gold for 9 ounces of silver. And we're trading at, as you just said, 80 to 1. So if someone could actually explain that to me, I would really like to listen to it. But, as a global industry, the miners are producing, for every 1 ounce of gold, we're producing 9 ounces of silver, which suggests to me anyways that silver is much, much rarer than people actually think it is. And, what the catalyst is to change that, I'm not, we don't know, but, there will be a day, in my view, and it's going to be in the short term, not in the long term, whereby you have, a Tesla or an Apple or a Toyota that just simply can't produce their automobiles or their products anymore because they have a lack of silver. And that's what's going to change the industry, and that's going to start showing up on headlines, and that's when we're going to start to see a big change in the current ratio to numbers that I think it should be trading at, which are closer to the production ratio of 9-1, which will obviously put silver at triple digits, which is the number I've been predicting for a long time.
Yeah, a lot of our audience members would remember the times where you've spoken to how industrial purchasers for electronics companies in Asia have expressed interest in purchasing directly from you. And you have a lot of insight into what's going on in the industrial market and how that could conceivably be a trigger going forward. Do you think that the process that we've been going through, where basically silver has been pushed down in paper markets, keeping the nominal price, the price discovery mechanism that we see out of the LBMA and the COMEX, is getting to the point where it's just the ability to keep prices down as long as they have been able to keep them down, which is, in fact, what's creating this distortion of the huge discrepancy, the gold and silver ratio. Do you think that that's just getting long in the tooth? And a lot of my fellow analysts subscribe to the notion that, we have to have some kind of a managed retreat, as Bill Murphy likes to speak to it, where prices just have to get allowed to be not manipulated as aggressively so as to create less pressure in the silver physical market, and allow, in fact, even the ability for manipulation interests to keep the price down without having their system blow up on them. When you look at the physical market, what's your sense of where silver is now? Do you have even a stab and gut read as where things stand?
Right. Well, before I get into the physical question, let's just talk about the market, for a second, because you kind of asked a two-part question. I'm actually quite positive about the future of a pricing mechanism for metals on a worldwide basis. I believe that the current system, the LBMA and this CME COMEX type system, is at the end of its ropes. I think, even though I'm not a huge believer, I shouldn't say believer, but a huge fan of Bitcoin, because, quite frankly, I missed the boat on it and I don't own it. And maybe that's why I'm a little bit skeptical about it. But I'm actually quite positive about the blockchain technology, because I think blockchain is going to be a way for mining companies to price their metals on a direct basis. So we could sell direct to consumers through a blockchain technology, bypassing all the current exchanges. I've heard, some groups, starting to talk about it, and I know of a couple of Glencore guys that just left, and they formed a business just recently, and they're doing some things in this area as well. They've contacted us, and there's some other stuff going on as well. So it's still in its infancy, but I think that whole system that we're currently pricing our metals at is going to end.
Do I understand you correctly? Do I understand you correctly to say that Glencore is actually looking into using blockchain directly for their own production, and see how distribution might happen directly, bypassing the exchanges?
This is not Bitcoin related. This is blockchain related. So
the blockchain technology is what I meant, not Bitcoin itself, not using a cryptocurrency, but the underlying architecture to make transactions and so forth, the crypto paradigm.
Yes, there's work going on right now to create a system using the blockchain for pricing metals.
And if that kind of thing is implemented, then how do you think that could impact the manipulation of the gold and, I guess, silver market? Like, do you think that could possibly end the manipulation?
Well, what's going to happen is it's going to remove, in my view, this is still early stages, but it'll remove the whole system of marginal banking, or where today we have over about 300 times margin on silver, because for silver trades on a global scale about 1 billion ounces a day. And virtually all of that is paper. 90+% of that is paper. The miners produce 800 million ounces a year, so we're trading 300 and, just using simple math, we're trading 365 billion ounces a year on the exchanges worldwide, and we're only producing 800 million ounces a year. That's quite a lot of leverage, in my view. So if you get away from the exchanges, that leverage just disappears. So you have a much more fair pricing mechanism. And going to your other point, the physical supply demand, just to finish off your question. And I've already touched on it a little bit, but if you go back to 2015, the mining industry as a whole worldwide produced 850 million ounces of silver. In 2016, that number was 800 million ounces, a reduction of 50 million ounces. We know in 2017 that Chile is down approximately 10%. I actually heard numbers as high as 14%. It is down some number close to 10%. We also, we know Canada. We know Mexico's down 5 or 6%. And these are early numbers. So if we add it all up, speculation is that the mining industry as a whole produced something in the order of 750 million ounces in 2017. We won't know that number until April, May of 2018. But nevertheless, so we're seeing declining world production of silver and increasing demand for the metal. And this is a perfect storm. The market quite hasn't picked up on this yet, but this is a serious issue.
The first indications you had from industrial suppliers knocking on your door was a couple of years ago, if memory serves. Have you seen any uptick in the level of interest in that similar kind of expression of interest from industrial suppliers or buyers, excuse me?
Well, not, I don't think they liked our response. So,
yeah.
So the answer is nothing serious. We did have a couple of serious groups. One of the largest jewelry manufacturers and one of the largest electronic manufacturers did approach us a couple of years ago, but we shied away from a relationship. And but we get emails from India and China and places like that looking for silver on a fairly regular basis, and quite honestly, we just ignore all that. Those requests. We're comfortable with the sources that we use currently.
Now, moving back to gold and silver in 2018, it looks like the Fed may raise interest rates a couple times again, and also we have the tax cuts that are being implemented with the new tax bill. How do you think those two things could impact the gold and silver markets, Keith? I
don't know. Warren Buffett said the other day that he's never made an investment based on what the Federal Reserve does. These governments are, amok, and they're going to do what they're going to do. And, as investors, we have to, do what we're going to do what we believe in. And, when it comes to gold and silver, I'm all in. And I've been deploying capital in the last 6 months, into some of my favorite names. I've been buying quite a lot of First Mining Finance. I've been buying some other mining stocks as well. I think this is the valuations that we're seeing in this sector are just absolutely amazing. And this is the time that people should be taking serious looks into good quality, well-run companies. And, we'll see over time whether I'm right.
It'll definitely be interesting to see what happens with the mining sector and precious metals when we see the stock market roll over, and it's been 10 years running now. And the most unusual equity market and bond market because of all of the liquidity that's been pumped into the market, upwards of even as much as $300 billion a month at times when you count all the different various ways that central bankers are generating liquidity. So,
yeah. Well, whoever gave the governments permission to buy stock?
Yeah. Or even the Federal Reserve even having the ability to have on their balance sheet anything but treasuries. They've rewritten the rules on everything.
All right. Well, Keith Neumeyer, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where people can find you online?
Well, sure. The First Majestic, it's obviously one of the pure silver companies in the world, and for those people who like silver should take a closer look at First Majestic. Feel free to look at the company's corporate presentation on our website. We're looking forward to interesting 2018. Hopefully the metal prices improve, which will add to the excitement. And at First Mining Finance, there's a lot of drilling that's been going on in 2017. I'm the chairman of that company, as most people know. And there can be continued drilling and progress of its development process throughout 2018. First Mining is focused on gold, in Canada, and obviously First Majestic is focused on silver in Mexico. Their websites are simply firstmajestic.com and firstminingfinance.com, or people can follow me directly on Twitter, just Keith_Neumeyer, and then be pleased to have additional followers. I don't do a lot of tweeting, but the stuff I do send out is hopefully of interest to your listeners.
This has been your SD Weekly Metals and Markets Wrap with Keith Neumeyer, our co-host Eric Dubin, and also Elijah Johnson. Thank you so much for joining us.